All right, let's give it a big round of applause. Welcome.
Hold it close.
Hi there. Okay. So we've just talked about Bitcoin 2.0 here. And we're going to do, this is really the subject of this topic, because talking about pricing future in related to Bitcoin is really fundamentally it's only relevant from about mid last year onwards. That's when you saw the stabilization in the price. Okay, so one thing that people tended to confuse when Bitcoin first came onto the scene is they thought it was a reappraisal of money. They thought it was a reappraisal of, they thought that Bitcoin was actually money. And it's not, it's value. It's possible to have negative money and positive value, as anyone who has loans on properties or has margin on stock will be able to tell you. So fundamentally, these two distinctions are very important, and they're especially important when it comes to Bitcoin and the future of Bitcoin, Bitcoin 2.0. Because we are talking about a reconfiguration of value for a new world. And a lot of this has to do with the Internet of Things. In a world where the Internet of Things, where so many things are being traded on a virtual platform, what happens is, if you imagine the quantity of things that are being traded suddenly speeding up at an enormous rate, you're going to need a different value configuration to be able to handle that. If we'll look first at the most basic type of value configuration there is, which a few years ago, two academics called Starbell and Fjellstad, they're Norwegian, wrote a paper, and in it, this is what they put. First is the value chain, which is, a very fundamentally simple business model of creating value. What was so revolutionary about this paper that they wrote, by the way, Starbell and Fjellstad, is that they were taking what were considered strategic models, and they were saying, hey, wait a minute, maybe it's not just about strategy, maybe it's about value. It's kind of similar to what's going on with Bitcoin. So the next value configuration they identified, and this was very new for the time, is a value shop, like a consulting firm, for example. Now, a consulting firm doesn't buy anything, but it does sell something. It sells knowledge, which back in '98 when they wrote the paper was still a relatively unexplored idea. And within this model, they identified that it worked in a cyclical kind of approach. So you had a series of processes that a consulting firm would go through. First of all, they would find a problem with your company. That's how they solve themselves. Then they would solve the problem with your company. Then they would give you a series of choices of which you could execute to solve that problem. So if the problem is that you're losing, so they found a problem that you're losing money in R&D. Here are your choices. You can fire half the R&D group. You can reorganize, whatever. Then they would execute. They would control and evaluate those different results, and they find a new problem again, and then they tell you another solution. That's how a consulting firm works. The third type of value configuration, which is, again, all of these we'll see are kind of relevant to Bitcoin 2.0. The third kind of value configuration is a value network, and the reason they've mapped it like this, with each square on top of each other, is because a value network worked completely differently, they pointed out, to a value shop, in that there was no process. There is no process of configuring value. There is no cyclical part 1, part 2, part 3. there is just value created by connecting individuals on a platform through a series of different paradigms. So these guys kind of put those paradigms into three different areas: service provisioning, infrastructure, and then network promotion. And so you've got these three different types of value configurations that exist in the world. Buy and sell. So I buy a widget, I put it together with another widget, and I sell it for a markup. That's a value chain. Number two is a value shop. I figure something out, and I sell the solution. And number three, I connect two people. So is Bitcoin in some way a new value chain configuration? And I think this is the most exciting aspect of the technology, personally. You know, it has attributes that look like all of these different value configurations. It looks a bit like a value shop in that there is a intrinsic knowledge process going on. There is a process going on within the blockchain. That is the chain aspect of it. It's definitely a value network. It's absolutely 100% a value network, and it also looks very, very like a value chain as well. In fact, it organizes transactions in exactly how a value chain organizes them. Now, someone who I work with at the moment, a guy called Thomas Power, is a big speaker in the UK, has identified that organizations have fundamentally changed over the past decade. And what they've gone from is being closed, selective, and controlling, which is what they used to be. And this is really what you think of when you think of a factory business, when you have a manufacturing business. That is a CSC business. It is closed, it's highly selective, and very, very controlling. If you do not run the business like that, you will lose money. To a new type of organization that is emerging, as I say, ever since about 98, that is open, random, and supportive. So, and this would be your Google type company, and that is a very, very different way of running a business. So, when we look at the blockchain, is it a new value configuration? And I think we can use, for the purposes of this presentation, Bitcoin 2.0 and blockchain as a value configuration as a synonymous pair. What I have kind of summed them up into one expression, which is factory banking. And here it is. Look at how all of the components come together. The value network is laid down right in the middle. That is the network aspect. It's also the chain aspect of the blockchain. Going around the value network are those value shop processes, one by one. The problem finding and acquisition. In fact, the problem solving and execution in the blockchain is the identical process, the same identical process. Whenever, in order to create a Bitcoin, a problem is solved. And these two are bound together via that value network attribute that runs straight through the middle. And all those golden parts along the outside are the fragments of the value chain model that binds the thing together. The blockchain and Bitcoin 2.0 is an entirely new value configuration for the Internet of Things. That is what it is. In an Internet of Things, you cannot trade things at such a high quantity. There is going to be a huge quantity of things being traded. We just heard from Ellie on the panel how these contracts take absolutely ages to sign and deliver and back and forth and this. You cannot have that time. Velocity will speed up. If velocity and volume both speed up and you don't have a new value configuration to accompany both, then either one will fall. You will get a reduction in velocity or a reduction in volume of transactions. which means you're back to square one. There is no supportive infrastructure in the world from a value point of view other than the blockchain right now that can harness the potential of the Internet of Things. The Internet of Things will be the Internet of nothing without the blockchain. It's as simple as that, without a new value configuration, which, as I say, for this purpose, I call factory banking. And I call it factory banking because it is both a manufacturing process. The coin, the Bitcoin, comes out of the process of manufacturing at the same time as it is the unit that's spent. Now, of course, this doesn't just apply to Bitcoin. This could be Ethereum or any number of blockchains. And there are very sophisticated people who are much more sophisticated than I on what those different blockchains can do for different transactions. That is a subject for another presentation. But that's the first part of this, which we just covered, is really to understand that this approach, factory banking, which we can use to encompass all blockchains, is that the blockchain is a value configuration. It's a way of configuring value for a very, very different transactional world. So I'm going to look at two cases very quickly of real trading and sort of point out how disconnected the trading reality of Bitcoin is from the fundamental configuration reality. We're going back last year at some point, when I was putting together a piece for CoinDesk. I kind of did an interesting exercise whereby everyone was trying to predict what was going on with the price. And so what I did was I took all the data on the CoinDesk BPI, and I took the April to November 2013 average purchase price, which is right there, $111. I took the year-to-date average purchase price, which we were talking about about 1 year ago from today, probably about May 2014. Probably a bit later, August 2014, sorry. So August 2014, the year-to-date average purchase price since April 2013 was $563, according to the data on the BPI, which was 4 different exchanges. At that point in time, there are many more exchanges on the BPI today. The 18-month, and then I took the 18-month, which was 337. And I figured, I bet in the interim term, the price falls to about the 18-month. Purely on the human rationale that most people will have bought on that 18-month price curve. And most people don't like to realize at a loss. So they hold on. That remained the 337 price for the next quarter to 2 quarters, the average purchase price. This is a very interesting anecdotal example of how much the value of Bitcoin is reliant on someone's personal purchase price, the price they paid for the asset. What that tells us really is that there is no fundamental analysis going on of the value of Bitcoin, which is quite an important. That either means that Bitcoin is way overvalued, or it means it's way undervalued. One or the other. Second case study was at CoinSpeaker, where I'm editor-in-chief. I had a source of mine who runs a margin trading outfit out of Canada. And I said one day, can I look at your books, please? And he said, okay. Well, he said, can you write something about me? Because I want some more news. And I said, well, you've got to give me a story. And he said, well, what story can I give you? I said, well, I want to look at your books. So he thought about it, and he said, all right, I'll show you my books. So this was the morning of, this was morning trading. or one morning he showed me, this is the morning trading from a period of about 10 o'clock to 12 o'clock in the morning, right, on these particular days that you see highlighted on the screen. What I thought was so interesting about this particular chart is that you can see that when there is a rush towards, now at that point in time there was a massive downward pressure on the price of Bitcoin. But what is so interesting is that you can see that when there is a trend, about 2 days in, there is an almighty, if you look at the very bottom of that spreadsheet, you've got $10,000, $10,000, $10,000 sell transactions. It's just piling on. I thought this was kind of related to the first case study and kind of indicative in that sometimes when you have a price point that you think, I think Bitcoin's going to go here, it goes a lot lower than that because of these last minute guys who are laying on margin bets. These are margin bets. So 80% of this capital is just margin they're using to punt, which means that if it goes in the wrong direction, they're going to be out of money very quickly. But this is really to kind of highlight the importance of being very, very flexible with any kind of trading strategy, because these are actual people's orders. And sure enough, during this period of time, I think the price went to a 2-year low. All right, so going back to this idea that it's a new value configuration, there are two aspects to calculating the value of Bitcoin, or Bitcoin 2.0 if you want. There is essentially a production side analysis. Because a Bitcoin is being produced out of the value configuration, we have to work out a consumption production value. So we have to take into account the savings and spending side of the coin. Then on the other side of the coin, there is the financial aspect. This is why it's such a new value configuration unto itself. It's the first value configuration ever to syndicate both production and financing. Financing and production have always been separate components of a value equation. Always. As the factory owner, you go to the banker gives you a loan, you negotiate. They're not. They are part of the same value configuration within this. That is a very revolutionary concept. It is the only way you can transact on the Internet of Things. You cannot wait around 3 months for a loan. If you are going to have to pay for a ton of stuff, you cannot wait around 3 months for a loan on an Internet of Things, because that's not what an Internet of Things is. An Internet of Things is instant supply, instant demand, instant transaction. So, and then we're going to look at the investment analysis side of the Bitcoin, and we're going to then perform a kind of final analysis, which isn't a perfect analysis at all, but it will be an interesting analysis nevertheless. So for the savings and spending analysis, what I did was I took fortunately, someone already did a savings and spending analysis, but they just didn't do it very well. It was a Citigroup economist, I think, who did it at the end of 2013, and basically came to $1,500 per Bitcoin, which was kind of convenient because Bitcoin at the time was $1,200. If you notice, analysts always mark the thing up by about 25% if it's on an upward curve. If it's on a downward curve, they'll always mark it down about 25%. So it was hardly surprising. And I looked into the numbers and I suddenly saw that, wait a minute, these are wild out. For a start, he was assuming that only 10% of US households actually purchased on the internet, which is kind of crazy because 80% of all books, for a start, I know for a fact, are purchased online these days. It's one of the big problems that Borders, Foils, and all the rest of them had. And it's about 50 to 60% of goods are purchased online these days. So 10% was way out. The other thing he was doing was he was using 2012 numbers. Well, why he was sitting at the end of 2013 with the hindsight of the year and then using the previous year, I mean, those fit the $1,500 valuation that he wanted. clearly. So there were another couple of problems like that. So I just kind of put in the correct data from, and I used federal. This is, you know, these are where the world. I think for the purpose of this analysis, I used the FBI data because it's pretty good. And so anyway, this is what we got. If you are going to, but his actual concept of doing this valuation was really clever, which was, wait a minute, you know, there's X amount of people who are spending online. If you assumed that just 5 to 10% of those X amount of people were going to be using Bitcoin on average over the next 10 years, you know, what would it look like at the moment? So I mean, I thought that was pretty good conceptual thinking. In that case, that's where Bitcoin would be. It would be $7,500. A lot of people find that hard to believe, but I mean, that's where it would be. The numbers don't lie. I mean, I kind of ran them 3 or 4 times to check, and that's where it would be. Now it's very obvious why the guy was using 2012 data, right? The last thing he wants to do is publish a paper saying Bitcoin's value is $7,500. I think Citigroup would fire him. Okay, so then you have to assume, this is one of the things about evaluation analysis they often don't take into account when talking about Bitcoin. Bitcoin comes in a world with multiple other currencies, virtual currencies. So you have to assume, when you do evaluation of Bitcoin, certainly on the factory banking, Bitcoin 2.0 side of things, what you have to do is you have to value Bitcoin according to if it's only being compared, not with the US dollar, not with the renminbi, not with the South African rand, not with the Japanese yen, but only with its other peer group of leading currencies. And so this is what I did with a guy called Colin Evans, who started a currency of his own called Cork with Bill Still. He's a kind of genius individual to work on certain things with. An incredible mind. Anyway, so we came together to do this evaluation, because one of the challenges of doing such evaluation is Bitcoin issues only a hard cap number of units, whereas all these other currencies issue indefinitely a number of units. So we had to come up with an equation which we represented as this EQI number here, which essentially reconstituted the Bitcoin as if it was a currency that would issue forever, right? At a continual rate. Okay, so this doesn't really tell us a lot more than what the par issuance value of Bitcoin is against the dollar. Now, the par issuance value against the dollar is $8. So Bitcoin, in its own universe of virtual currencies, has about an 8-to-1 value on the dollar. And then, not to spend too long on going through this one, if you are really interested in this, you can get in touch with me afterwards, and I will send you the paper behind this. It'll take about half an hour for me just to talk about how we arrived at this particular equation. But anyway, what we were trying to do was work out, if you look at the value of the dollar, you cannot value the dollar as if it's never been invested. About 99.5% of the dollar's valuation over the past century has been because it's invested. If it was never invested, it would have zero value. So you have to work out what component of this of Bitcoin is derived as a result of it being invested. And people say, well, is Bitcoin really invested? It will be, and it is. I mean, people invest Bitcoin in things, right? They invest them in crowdfunding projects, or they invest them in whatever, and that will only increase. If that is the case, we arrived at a 22 for 1. 22 for 1 ratio. So what that means is that the Bitcoin, $1 of Bitcoin will produce $22 of Bitcoin in terms of its investment return. when it's invested. And that's a very important part of the calculation of any form of money. So you've got three here. Savings and spending. We've got the par, the issuance value. When Bitcoins are issued, what are they issued at par? And then we've got when that par value of $8 is invested, boom, what does it return? So for every $1 of the $8, it returns $22. And then we come to the final question. What's a Bitcoin worth? Buy and hold, right? Okay, so to do this, we can say that the blockchain has a value of $7,500 per Bitcoin, which gives the blockchain about $170 billion valuation. It's pretty impressive. I mean, if that had a market value, assuming a 10-to-1 multiple, assuming a 5-to-1 multiple, you're talking the largest company in the world. It has a par investable value of $8.22 and returns about $22 on the dollar. So if you configure all this together, what you end up with is about $60 of the current Bitcoin price is absolutely pure Bitcoin. Okay, is not to do with the other coins on the market, is not to do with the news value and the hype and whatever is going on. So you can say that it's fairly safe to project that 25% annual returns are achieved on Bitcoin every year, cumulatively reinvested. And that is how we arrived at the final figure. The 25-year valuation for Bitcoin is $11,925. And people, again, say that's pretty high. It's actually fairly standard if you look at the history of asset price increases over the last 25 years. So, I mean, it's fairly consistent with what other assets have done, being real estate, stocks, bonds, well, not bonds, but certain bonds. Okay, and that is the end of the presentation. Thank you very much for participating. You can buy my book on Amazon.com. Go check out my website, www.dmh.co. Thank you very much.
All right, well, next time we're going to have you do a book signing. Bring some books and we'll have you sign them. That'd be awesome. We got our next panel.